clues to the market based on stock market data. There's no guarantee that any signal will be timely or accurate. Investors should be aware that the analysis here is designed to inform, not avoid all losses that might be incurred. Past performance does not guarantee future results. And we're bearish. Here's why. The market went into a shortable correction, which I signaled on April 10th. The rate of decline is less than 190, which it was 178. So the market is declining. The price is declining at a fast pace. The normalized new lows, both at the top and sell signal, generated confirmed signals. Okay, so the number of new lows is expanding at the top and the sell signal. And a calculation I make of how fast the new lows is dropping or rising is greater than 40%, which is true. Okay, interesting too. Okay, and here we have charts of the stock market presently. As you can see here, on November 14th, we had a major buy signal. The market went up, and this was generated as not the time to sell. So we maintained our position in here and here. And now on this date, April 10th, we got a sell signal, a major sell signal. Hopefully it holds, maybe it won't. But coupled with the market strength indicator here, this indicator went above 3.8 at this point, and that's the time that the market is strong. When the market strength indicator is above 3.8, the market is strong. When the market strength indicator is below 3.8, the market is weak. So time to be in the market at this time. So I made a discovery too. When the shortable correction coupled with the market strength indicator is not below 3.8, then it's not a good time to actually short, but a good time to get out of your stocks anyways, and then re-enter when the market is more benevolent. Or yeah, so, and here we have the confidence index. It draws a nice straight line. You can see here from November all the way up to here, and it's still bullish. But this is for the New York Stock Exchange, and for the Nasdaq, it came down and actually crossed bullish here. But as you can see, the market had a nice rise from here up to here, and then time to be defensive for the moment and not try to maximize gains on the upside. And here's the internals. Okay, advanced decline, up down volume, new highs, new lows, and these are compared to a moving average, the blue line. And when it's above the blue line, we have a nice time to be in the market. So that's this. And now with these, the New York Stock Exchange and the Nasdaq both signaling that the market has weakened to the point it's time to come out. So that's the idea. We do not make a forecast as to how far or how fast the market is rising. We just do as we please. The Moon Run Report and how you can use it. Okay. The Moon Run Report is only $10 a month, and the first month is free. Bargain and good advice. Intent: invest in proven portfolios to generate high returns. Sell out before a bear market hits. Buy after the bear market is over. My track record: world champion in 2008, runner-up in 2009, and bond timer of the year in 2019. Fidelity account, doing very well, 20% a year. And since 2008. Holbert Financial Digest, actually I'm number one for the past 12 months and doing very well. That is an outstanding track record for how you can analyze the market, make decisions, and make money out of it. So that's what we did. Called the bear markets in 2008, 2011, and 2018. And we have a few things to say about the Moon Run Report, and I will let you read it for a moment.
Yeah, we got a couple of guests joining us already.
Oh, good.
4.
Okay.
And more coming.
Okay. Examining the portfolios. This is what the portfolios on the Moon Run Report can do for you. I have a small cap portfolio, back tested from 1999. about 50% gain per year, back tested, and has performed very, very well during the past years when I've used it. Maximum drawdown, 36%. That's not too bad. Turnover rate, around 354% a year. And so sufficient volume to buy it and not disturb the price of the stock buying. Here's a chart of how the stock, the small cap performance. This means percent over here. 2,600% apparently from beginning. That's not too bad. 2.6 million percent. Okay, minor cap. Back tested from 1999 to 2024, a 24% gain per year. Maximum drawdown about 26% and a little bit of turnover. And sufficient volume to not disturb the stocks. And here is the chart of the minor cap, 24,000% from 1999 to the present. Nice smooth curve. Mid cap portfolio. This generates a back test from 1999 to 2024, 25.743% compound average growth rate. Maximum drawdown, that's not too bad, 18.84%. And this is sufficient volume to not disturb the stock when you buy. And here is a chart of the mid-cap formula, 28,000% or about 30,000%, all told. So not too bad. Large cap portfolio, back tested from 1999 to 2024, 23.87% compounded average growth rate, and maximum drawdown, not too bad, 26%. That's good, and enough volume to push keep the stock from moving too much when you buy it. All these, here's a chart of the large cap portfolio, 30,000%. That's not too bad. It's actually pretty good. Since 1999. As you can see, these charts do not have big drops in them. Well, that's because we exclude the bear markets, which we claim to be able to do to avoid the bear markets. And you can see a horizontal line here when we delete the area where it went down. Altogether, combine all the portfolios, 31.96% average. Maximum drawdown, a low 20%. And here's when you combine all these together, you get 110,000% going in this way and up. How much $100,000 invested becomes in 10 years? Let's go jump all the way down to combine. 1.6 million, that's not too bad. That's 10 times, 15 times maybe. So you're doing very good if you combine them all. And they all do very well by themselves too. How much 100,000 becomes if after 15 years, combined 6.4 million dollars. So that's 64 times. No one calls bear markets like Brian. Okay, we have YouTube videos on the on YouTube, which feature various things. There's about 25 of them there. They look at the book Before the Bear Strikes, the website Moon Run Report, and the Money Smart Show, which we do here. Go to YouTube.
Post a video link in the chat already. So please join our Money Smart Show in the YouTube channel if you have not done so.
Okay. 1987 to the present, bear market calls and back tests. So we do that. Tsunami indicator. Okay, I go through and do all the descriptions of what the tsunami indicator can actually do for you as a signal for getting out of the market. This was invented in 2005. Okay, I made a decision. I looked at two things. Number one, the market stalls out, which means from the top to the sell signal. I look at how fast it's declining per day. If it's declining at a pace of less than 0.5% a day, then I see then that signal's true. If it's more, then it's a correction, not a bear market. And then I look at the market strength indicator, which determines how strong the market is at the top of the market and the sell signal. So if it's less than 4.5 at the top and less than 3.8 at the sell signal, then the market is weak. So at this point, we will look at the 1987 crash. Okay. Tsunami's indicator flashed a sell signal at this time. Okay, here's the buy signal preceding it, and at the top was here, and here is the tsunami indicator reading on September 8th, 1987. Now, one thing about this is that the VIX was not invented until 1990, so I couldn't use really this. So I used the basic formula of the rate of decline and also calculating the number of new lows greater than 100 at that time. So, but if it isn't, then this one, the shortable correction, which is also a bear market type of signal, flashed over here. So I have two types of signals, and if one doesn't get you out, the other will. So the PEP indicator, we got a buy signal here, and when this PEP indicator, which supports the idea of going back in, it wasn't above the threshold, which we have at 3.8%, and it was only 2.598. So it says we're not going to go into the market at this time. So as you can see, a big collapse into December 17th. So that's what we did.
Brian, I have a question.
Yeah.
What is the indicator on the one before October 8th? I mean, you have another flag on the white about
this buy signal.
The sell signal, right before October 8th.
This is October. This is October 8th. This is the sell signal at this time.
Okay, but the one before above that is not.
This is a buy signal here, and this is the sell signal. This is This is the when the tsunami indicator flashed here. It was that. So So anyways, we also have a requirement, the VIX be between 19 and 25 when the tsunami indicator flashes. So that needed to be reconciled. We needed the VIX to actually do that. So I'm going to go back to the last two slides and show you this example. The tsunami indicator in 2008. Now the rate of decline was also, everything matches number of new lows. Market strength indicator at the top, at the sell signal, everything is matching, and we go into this collapse here. Here's the top, and here's the tsunami indicator reading, and as you can see, a big collapse into December. So that's what happened. So that's the idea. Tsunami indicator works. It just hasn't flashed very often recently, but other signals have taken. Okay, the idea behind the market is the calling a bear market is that the market actually needs more than one type of signal. One size fits all does not work. Okay. Once I invented the tsunami indicator, I realized that I needed more things to identify the collapse before it happens. So there are 4 setups to the bear market. Each setup was invented with a concept. The concept is necessary. You need that to describe the way the market is setting up to go down. Each decline was divided by market weakness and was measured by the market strength indicator. Okay. Metrics identify the different setups with mathematical indicators. Tsunami indicator, 50 new lows rule, accelerating new lows, and shortable correction. Now, the shortable correction does not need the market strength indicator, and it flashed this time on April 10th. So, okay, we have this way of actually identifying collapses. It just so happens when the market strength indicator is below 3.8, when the shortable correction is flashed, it has a better chance of working when you go short. Now, so anyways, that's one idea I have right now. 4 signals, okay? Tsunami indicator, the market stalls out, and the internal start falling apart. Two concepts. 50 new lows rule. The number of new lows is extremely high at the top. Usually what happens during a 50 new lows rule operation is that usually what happens is that when the market goes up, the number of new lows goes down. But in the 50 new lows rule, the number of new lows starts going up. And that says that the market is splitting apart. So that's one thing I look at. The accelerating new lows, the market is starting to just fall apart. Now, that happened in 2020 with the COVID crisis and also in 2009. So anyways, and then shortable correction is what we have now. And we are looking for some downside action here. There are some dates that I want to discuss here. 2005, the tsunami indicator was invented. Okay, that's my discussion before. And in 2008, I called the crash, and it was successful the first time. 2013, I invented both the 50 new lows rule and accelerating new lows at that time. Now, 2014 followed up. The shortable correction was invented to take care of smaller declines, but still dangerous to be in the market. The accelerating new lows failed in 2020, the first time in the COVID collapse, and I revised it, so hopefully it works the next time. And a shortable correction failed, and I revised and was successful every time since. Okay, every single time. So we have a workable system. Preliminaries. Normalized new lows. Here's what I need to know before the market collapses. This is useful for showing the pulse of the market. Okay, and this is how it's calculated. We since the number of new lows fluctuates, but also fluctuates with the number of stocks in the stock market. Okay, and we use NASDAQ for this normalized new lows. Okay, multiply. Rate of decline. So the rate of decline shows how fast the market is declining from the top to the sell signal. Signals falling less than about 0.5% means the market is stalling out. And we use the calculation of X over Y instead of Y over X. It uses the number of days from the top to the signal to decide the calculation. Okay, when the rate of decline is greater than 190, it's true for the tsunami indicator, so the market's stalling out. Rate of decline is not used for the 50 new lows rule. Rate of decline is when it's less than 100 for the accelerating new lows. That means it's true for that case. And the rate of decline for the shortable correction has to be below 190. So they all added up. Market strength indicator. This is another supporting indicator for the bear market decision-making tools I have. Shows how strong the market is. Okay, we take all these things, advanced decline, up, down volume, new high, new low, price, and a VIX. Okay, we take 25 divided by a VIX because the VIX is an inverse operator and 25 is considered neutral. It fluctuates between 10 and 40 most of the time. So when it's stronger than the 4.5 at the top, that means it's a strong market. And when it's above 3.8 at the sell signal, that also means a strong market. And the inverse, of course, shows different. Tsunami indicator, the first one.
Brian got a question from Harash from the audience here.
Okay.
He has a question. The shortable correction seemed to result in a whipsaws in and out of the market. Why not just stick with the tsunami?
The tsunamis has different metrics that it looks at for a bear market, and it did not flash this time. That's the thing, you know. It only flashes when we have supporting indicators, and the shortable correction this time actually is not over yet. Okay, we did not get a supporting buy signal on Friday when the Apple went up and the market went up. Okay, so we're still on the defensive here, looking for time to get back in. Now, it may not have caused a large drop this time, but we're still waiting for confirmation. Okay, we came out of the market. I made a little bit of money using puts. Okay, and but not very much. And I am. But we're still this. There was one case when the shortable correction did not work, and it happened to be in August of 2021. Okay, it went down and went back up, and within a week, about 10 days, it was all finished. And the reason why that is because the market was just too strong. Okay, the market strength indicator, when the shortable correction came in on August 17th in 2021, was not below 3.8. So that's a caveat, and we will use that next time. But really, shortable correction is dynamic and usually does have sizable declines. Not necessarily this time. It only went down 8.5% during the last few weeks, but it's not over yet. Okay.
Right.
Here's the example, the 2008, which I showed before. 50 new lows rule. 50 new lows rule shows the market is splitting apart and unsustainable. Normalized new lows greater than 50 at the top. Okay. Rate of decline not used. Like the tsunami indicator, we have readings of market strength indicator at the top and the sell signal. And VIX has to be between 19 and 25 at the sell signal sweet spot. Here's an example. Back in 2000, the tech bubble burst. Okay, and this is the date that it did it. The sell signal came in at March 20th, 2000. Okay, we have these metrics here, which all confirm normalized new lows, market strength indicator, and the VIX. So that's what we have. Year 2000. Okay. Here's that big run up starting in October of 1999, and it went up and up and up, and people were jumping in and out of the market, and it was so much. The 50 new lows rule came in at March 20th, 2000. Accelerating new lows rule. This accelerating new lows determines when the market is falling at precipitous speed. Rate of decline, this thing is just going down fast, down less than 100. The VIX is greater than 23. Market strength indicator at the sell signal less than 3.8. Now we don't need to have the market strength indicator below 4.5 at the top. The reason being is that when this thing starts taking off, it doesn't matter what happened at the top. We have a dynamic situation when you need to sell. And the accelerating new lows calculation, very much like what we have with the shortable correction, but this time it has to be greater than 50%. Okay, accelerating new lows in 2010. We have this situation. The sell signal date was January 22nd, and the metrics all add up. And here's the when it came here, the time to stay out of the market. Now the market did go up, but the PEP indicator here came in less than zero, actually, less than 3.8%. The accelerating new lows came in here, and we stay out of the market until here. Now you might want to, it might have been more useful to come in here at the market, but this is when our PEP indicator actually came in greater than 3.8. So this is the time to invest. But here's a flash crash. Everybody remember that? We were at a restaurant one day, and we after that, we went to a Fidelity meeting in Wexford, Pennsylvania. And while the guy was lecturing, when I saw the market go down, and that within about a half hour, I think it was. And it was really a big drop. So it was just a dangerous time to be in the market. It fell apart, and then time to get back in is that. And the shortable correction, here's what we have. And this is what's going on now. The normalized new lows at the top, and the sell signal increasing to the point that we need to be out of the market. Accelerate new lows also 40%, and the rate of decline less than 190. And here in 2015 is a case where the market fell apart. June 29th, 2015. This terminated the decline, the whole situation terminated, and the buy signal was given in March 1st, 2016. So that's what we noticed there. It was just a time to be out. At the time, I had invented the shortable correction code at the 2014. I wanted to watch to see if it actually worked, and by golly, it did. And I should have come out. I lost a lot of subscribers at this point because I did not come out, but I figured, I just didn't want to risk it. I didn't know how to handle this time, and now I do. So that's the case. If I fail to call the bear market, I sell a 20% loss in Russell. Okay, do not argue. The market's plummeting. Get out. If you don't call it, well, that's the way it is. So I just don't want to hang on to the bottom and disappoint everybody. The minor sell signal is also something, a package of the Moonrun system. The signals are the time that I will accept the market to go down and lose a little bit of money. We're not going to sell really a lot, but these have never turned out to be a bear market since 1987, and they may be scary. Sell signals like this, it's time to stay in the market, and by the time the buy signal comes back in, the market more likely will be higher than the sell signal generated. So you want to stay invested. That's how I am successful in the market. You stay in during the weak periods, and you keep in during the other period. Getting back in the market. Okay. Characteristic of bear market bottoms. The short to intermediate market timer tool gives a buy signal, and the PEP indicator, which I describe in the book before the bear strikes, needs to be above 3.8%, which shows a strong pulse in the market. And describing those charts all the way through that I showed you today, they were always above 3.8 when the market went in. So the PEP indicator, this calculation is found in the back of the book before the bear strikes. First, you have something called the market momentum indicator, and then you take that and you describe the 8-day EMA of the market momentum indicator. It's a subtraction, okay? And it gives how strong the pulse of the market is when they get back in. And here's a chart describing the PEP indicator action. On December 12th, 2008, this gave a buy signal to terminate, get out of the market, to get back into the market. But the PEP indicator was at 3.09, which signaled that the ensuing rally would not all be that great. So as you can see, within a few days, we ran into something called the accelerate new lows, which was, this is what the accelerate new lows chart signal was, and it went way down here. And by that time, we had tremendous losses in the market, and but it did terminate the 2008 scenario when the PEP indicator rescued the market with a 13.17% reading, which is greater than 3.8. So March 18th was a time to signal to get back in, and that's what we have. And that's our show for today. And I'm going to click this off, stop sharing. And Matt, do you have something to say today?
Yeah. Well, anyway, I think that's great. Review all the key indicators. I think the tsunami sounds pretty interesting. Let's ask the audience. Any other questions? Robert, Lawrence, Harash? You can.
Okay. Thank you very much, everyone, for showing up. Another show from the Moonrun Report and the Moonrun System and everything that goes on with the Money Smart Show. Okay. Anything else to say? Anything else to say?
Yeah. So please join us, the Money Smart Show, in the YouTube channel as well, and share the link from the YouTube and also from this portal here. All right. Thanks for joining us, and see you all next week. Same time.
Okay, thank you, everyone. Okay, bye-bye.
Bye.